Hi everyone, this is Mehul Mehta and welcome back to my YouTube channel. We are simulating a mock interview specifically on derivative. Derivative is the most asked topic in any quant interview. They'll ask you a bunch of basic derivative questions and a lot of questions on derivative pricing models. So all the people that you see in here, they all are master level students, and the idea is to help all of them to understand what kind of interview questions are asked in any quant interview. So all of them will be, so I'll be asking a bunch of questions and all these students will be replying. Okay. So just wait and see how, students replies in all these quant interviews, and just wait and watch. Okay. All right. So let's start with the first question. So the idea is anyone who knows the answer, just raise your hand and you can speak the answer. Is that clear? Okay. Sounds good. So the first question is, what is derivatives and what are common types of derivatives? Yeah, Agam.
Derivatives is the financial instrument whose value is derived by its underlying asset. And there are different types of financial instruments which are deal into the markets like stocks, bonds, commodities, and currencies, and the market index as well. So these are the types of derivatives which are traded into the market, and this is the meaning of the derivatives.
Okay, anyone else? Okay, so here is one thing. If I feel that the answer is not sufficient, I'll ask other person. Okay. Yeah, anyone else? Yeah, Ruby. I see your hands raised.
Yes, I would also, to the type of the derivatives, I would also add swaps and options, and FX products, maybe.
Okay. Okay. Anyone else? Yeah, Shivani.
Yeah, so derivative is a financial instrument which derives its value from its underlying asset, and types of derivatives are future forward swaps and options. And under options, we also have call and put option. So yeah, just to elaborate more on
Okay.
derivative.
Okay, that sounds good. If I were you, I would have answered something like you. If I feel that the answer is not sufficient, I'll let you all know the answer. So a derivative is a financial instrument which derive its value from a underlying. There are different underlyings which are stock, indices, bonds, currencies, commodities, interest rates, etc. Now, derivatives are used for specific for different purposes such as speculation, hedging, or arbitrage opportunities. Now there are different types of derivatives which are traded in the market. Specifically, there are four types of derivatives: forwards, futures, options, and swaps. So this is how I would have expected all of you to answer. Okay, so now can you all tell me what is the difference between forwards and futures? Yeah, Shivani.
Yeah, so forward contracts are firstly customizable contracts, and future contracts are not customizable contracts. In both of the contracts, like we have expiration date. The basic difference in forward and future is like for forwards, it is traded at OTC, and for futures, it is traded at authorized exchange. So yeah, it's
Two
basic.
differences. Yeah, Sai, please tell.
I think forwards are European in nature. They are settled at maturity, and futures, you can buy and sell continuously.
So you said forwards are European in nature. Okay. And futures, you can buy and sell. That is, I would say that is right. You are not wrong on that. But I would say a little language could be better. I'll let you know the language. But yeah,
Okay.
this is right. Any other differences anyone can think of?
I,
You,
I can add something to that,
you
Mehul.
let Yogesh speak. Yeah, let Yogesh speak.
Oh, sorry.
Yeah,
Sure.
sure. So, like in forwards, there is like higher counterparty risk, since there is no intermediary, and in futures, there is lower counterparty risk, since there is like exchange in clearing houses, and it guarantees the trade. So, yeah.
Okay. Any other difference?
Can I add something?
Yeah.
So futures are settled on a daily basis at the end of the day, every day, while forwards are, are at the maturity date,
Per-
expiration date. They are
Perfect.
settled.
Okay. So the answer.
Also, I'm sorry. Sorry,
Yeah, please,
continue.
Yash, please go ahead. Yeah.
No, so for futures in general are more liquid in nature because they are traded on exchanges, and whereas forwards, they remain to be less liquid because they are highly customizable. And yeah.
Perfect. Perfect. So see, whenever you are saying any answer, have five differences. If see the understanding, the the how the interviewer will be impressed is if you show more and more. Okay. If see, eventually anyone in the interview will say one or two differences, but the idea is to say five differences such that the interviewer is fully impressed. So how I would have gone about this is forwards are customizable contracts, futures are standardized contracts. Forwards are traded over the counter, futures are traded at the exchange. Forwards are highly illiquid instruments. Futures, on the other side, are highly liquid instruments. Forwards are only settled at the maturity. Futures, on the other hand, are settled every day. So that's why they are called mark-to-market instruments also. Now, one more thing is there is no central counterparty in the, or you can say there is no one in between in the forwards, but definitely we have central counterparties in between at the exchange, and that's why we say that the counterparty risk for all futures are less, whereas counterparty risk at the exchange, sorry, at the in forwards, or you can say at over the counter market, it's pretty high. Is that clear? So they make sure you say everything. Okay, so the next question is, what is the difference? Okay, what are options and what are different types of options? Yeah, Agam.
Basically the option is the contract where there's a right to there's a right but not the obligation to sell or buy the options. Um, yeah, that's what the option means, and
Sell and buy the underlying, not the options.
yeah, the underlying assets, buy the underlying assets. Yeah, that's what the option is.
And what are different types of options?
So there are basically four types of options. Long option. Mm, is that the type of an option, right? If the long,
Okay.
no.
You just say and I'll say if that's right or not. Yeah.
Okay, so basically what I understood what the type of option is, the long, so long call, short call, long put, and short put are the types of the options.
Okay. Now here is one thing. Long and short are just the position. Call and put are the types of options. Now I'll ask Yogesh what is call option and what is a put option, or anyone else who wants to answer.
Yeah, so like in a call option, mainly it gives the holder the right to buy the underlying asset at the strike price, and it is mainly used when the buyer expects the asset price to rise. And for the put option, it gives the holder the right to sell the underlying asset at the strike price, and mainly it is used when the buyer expects the asset price to fall.
Okay.
So yeah, that would be the main difference.
Perfect definition. Only one thing is, yes, you want to add something?
No, I was going to speak on the type of options, like differently.
Okay, so yeah,
Yeah.
if someone says what are the types of options, definitely call and put. Only one thing to add is it is not an obligation. Always remember you are saying that okay, it gives the holder the right to buy or sell, but always mention that it is not an obligation, and that's what makes it differentiate it with respect to forwards and future. Forwards and future both are obligation. Options on the other hand, they are not obligations. Is that clear? Okay, now can you all tell me like what is a European option and what is an American option? Who wants to go? Okay, Sai.
European option is exercised at maturity. I mean, the right without an obligation. And American option, you can exercise whenever the payoff is positive for the buyer or the on the buyer's perspective, if it is, uh, and it can be done continuously after it hits the strike.
Okay, okay, okay. And so basically, American option you can exercise at any point of time during the life of the option, and for European option you can only exercise it only at the maturity. Is that clear? Yeah. Okay. Perfect. Now, can you tell me can you explain what is the concept of moneyness? Anyone? What is the concept of moneyness in the option? I'll wait for. Okay. Yeah. Yeah. Sai. Please go ahead.
If the option is at the money, it's known as moneyness.
Okay. Yeah, Ruby.
Yes, moneyness is basically for a call the difference how far above the strike price the current stock price is. Basically, ST minus K is the moneyness. You're in the money. And for a put option, your the moneyness is K minus ST. How much below the strike price the current stock price is?
Okay.
Because a option price has two components. It has the moneyness as well as the time. What you call the time
Value of money.
the time value, yeah. So moneyness is that ST minus K for a call or K minus ST for a put.
Okay. Anyone else? Yash, have you raised the hands? So I see you.
So moneyness is basically it tells you the relationship between the strike price and the stock price. So if we are at the money, at that time we expect the stock to be equal to the strike price. If we are out of money, it means that the strike price is higher than the stock price for call. With respect to call, I'm saying this. And for in the money, we expect the stock price to be higher than the strike price.
Okay.
And
Perfect. So
similarly, it is opposite for put. Yeah.
So perfect answer, Yash and Ruby. Or Ruby, on your definition, only need to you need to add us. Definitely, as Yash mentioned, it is the relationship between the stock price and the strike price. When you tell the recruiter, you say that okay, there are three type of moneyness: in the money, at the money, and out of the money. So what in the money refers is when the stock price is greater than the strike, and specifically say that okay, this is for a call option that in the money means stock is greater than the strike, at the money means stock price is equal to the strike, and out of the money means stock price is less than the strike price, and just the reverse for out of the for the put option. But these were all great answers. Okay, so can you all tell me what are the assumptions of the Black-Scholes model? Anyone? Shivani.
Yeah, so
Okay,
the
so
first is
sorry, one thing is whosoever raises the hand, I'm just asking them. Okay, so if I'm not calling you, do not think that oh I do not want to ask. But yeah, yeah, Shivani, please go ahead.
Yeah. Oh, sorry, I just yeah. So the first assumption is Black-Scholes model is used for European style option. Second assumption is returns of like stocks are normally distributed. The third assumption is we assume that the risk-free rate is constant over the time. And then we assume that the volatility is been used as constant. Yeah, so these are the assumptions of
So
Black-Scholes
four
model.
assumptions. Still, I guess two assumptions are left over. Anyone who wants to, Sai, if you want to add any other assumptions, we cannot hear you, Sai.
I'm sorry. The underlying assets are log normally distributed. The volatility is constant,
Mhm.
uh, and interest rates are constant,
Mhm.
and there are no dividends.
Yeah,
Uh,
this was the point. There are no dividends that are considered during the life of the option. Okay, one more point is left.
Also, like there are no transaction costs.
uh,
That
yeah,
is the point that the market is efficient. That means which means there is no transactional cost. There is no arbitrage opportunity, right? There is one more point which is missing.
The price is continuous in nature. Like there's no jump.
No,
No? Okay.
law of one price. There is no arbitrage.
no,
Risk-free rate is constant.
already covered. So the answer, one more point is this: the Black-Scholes model can only be used for European style options. Shivani, I hope you did not cover that point, right? Or you
No,
did?
I did.
Oh,
I
you
just
did?
didn't
Oh.
cover the dividend part because we also have Black-Scholes Martin model which covers the dividend. So
Fine.
yeah.
Okay, so as I said, five assumption. The risk-free rate is constant. The volatility is constant. It is only there is no dividend considered during the life of the option. Then it can be only used for European style option, and then the markets are efficient, right? Okay.
Mehul, I have a doubt.
Yeah.
Can you just tell me what is the difference between the log normal distribution and distribution? Like
Okay.
there's
So
such a difference.
yeah, so there are two terms, log normal and normal. When we say normal distribution, okay, it means it can have both positive and negative value. Tell me, stocks can stocks have both positive or negative values?
Only
Yes,
positive only.
Only positive, right?
only positive.
Yeah, stocks can have only positive values. So that's why
Positive.
the stocks are log normally distributed, but returns can be normally distributed. We cannot say returns are always log normal. No. If returns are always log normal, which means that it will only have positive value, which means stock will only grow, grow, grow. It will not fall. which is not right. So when we say, so we always say that stocks are log normal distributed, which means stock can have only positive value and return on the other hand can follows the normal distribution, which means return can be either negative or positive. And that
Okay.
is true, right? Because stock can go up or can go down, right?
Okay. Yeah, perfect. Thank you.
So now, yeah, Ruby.
Here I have something to add. So in the Black-Scholes model, there is a way we can factor in the dividend into the formula.
Yeah, so that's
So,
yeah, that's where Shivani said it's called the Black-Scholes Merton model. In the Black-Scholes Merton model,
oh,
it
okay,
covers the derivative.
Morton model.
Yeah. Okay, now tell
Okay.
me how do you make the so when we say that okay, tell me how do we derive the Black-Scholes model? Anyone here can tell? What just the steps? I'm not saying to derive it, but just the steps on a higher level.
Can I?
Yeah, Agam. Let Ruby say it this time. Yeah.
Okay.
So I would say, first of all, it has two components, right? Like, I'll start with the minus k for a call option, minus k e to the power minus rt times NDE. I'll start with that part. That's part. It's more intuitive. So ND2 is the probability of ST being higher than k.
So I'm Ruby. I'm not
Uh,
asking the formulas. I'm asking the
No,
derivative.
no. So yeah, yeah. So that's where it comes from. The ND2 comes from like what's the probability that the call option will be in the money, and then we discount the strike price. Like how much are we paying? The strike price has to be discounted to the current. So that's why we that's what we are paying k times k to the e to the power minus rt times ND2. What's the probability the option will be in the money? And then the first part is S0 times ND1. So S0, of course, is the current underlying price. And ND1 is the probability that if ST is greater than K, then it's a conditional probability actually. Like by how much is
How
ST
to
greater than
derive,
K?
Ruby, the question is how to derive the PDE. I'm not saying what
Oh,
you're
the
saying.
P.
You're
So
explaining.
you mean like, okay, by using
That's the
Ito's
formula.
lemma?
Yeah, that is the question. How to
Oh, okay,
derive the
okay.
what you are saying, and also one more thing you said wrongly. You said ND2 is the how like probability we exercise in the money, but it's actually ND1. ND1 is ND1 is the probability that if we exercise it is in the money. That is what
Mhm.
ND1 means, and that is what
So
delta
then
means.
what would you say about ND2
And
then?
it means if it means the probability of exercising.
Okay, okay.
Okay.
Yeah,
And
right,
even is
right.
if it's
Okay.
in the money or not. So Agam, please tell what are the steps? Agam?
Yeah. Yep. So actually, I was also being with that particular like explanation. Like I was like that the Black-Scholes model like provides certain parameters to derive the fair value of the option price, whether it is call or put. So
Yeah, I'm referring
yeah.
to
So
the derivative.
first is the price of the call option. Second will be the price of the current of the I mean the price of the underlying asset at the then the strike price of the option, then the function that is the
Wow.
negative risk free. Yeah, so that's what I was also explaining that same. Yeah.
Anyone else in the group? Okay, so the thing is, okay, there are several steps of how we derive it. The first step is we assume that the stock follows a geometric Brownian motion. Okay, so you will write the geometric Brownian motion equation dst is equal to mu st dt plus sigma st dwt, right? So this is the first step. Second step is you assume that the option depends on two things, the stock price and the time component. Okay, so now because the stock price follows a GBM, which means uh, because now the dependency of our option is on a stochastic process. So that's where the concept of ethos lemma will come in. So the third step is to apply ethos lemma. Okay, so after we apply ethos lemma, the fourth step is we assume that our portfolio is comprised of two things. We are shorting the option and we are going long on the stock. So and then we differentiate this. So once we differentiate this, we'll basically put in the price of the stock and we'll put in the price of the ethos lemma, because ethos lemma tells you how the evaluation of option happens. Okay, so we'll put these two components in that. Then the next step is we'll assume that our portfolio grows at the risk-free rate, which is and then once we make this assumption, we'll basically what we derive the rest of the PD, and whatever the last final equation is, that is actually the Black-Scholes PD equation. Then the next step is you assume terminal boundary conditions, which is basically if it's a call option, you'll take maximum of st minus k comma 0. If it's a put option, you'll take maximum of k minus st comma 0. So this is more from a derivation perspective, how you arrive at the PD of the Black-Scholes, or how you derive the Black-Scholes equation. Yes.
Actually, I have a doubt. Honestly, like when you start from the price of the underlying asset that follows the geometric Brownian motion, can you tell me that how it works? Like, okay, with a theoretical perspective, I understand that, okay, we first go with the GBM, then the ethos lemma, and then we move forward, right? But like when I saw the a previous video of yours where you explained the Black-Scholes model, you explained the parameters which were into the formula to derive the Black-Scholes value for like that's what I understood, because this was something new that I came right now.
Okay, let me share my screen quickly, and we won't add a lot of time because again it's an interview, mock interview. So can you all see my screen?
Yes.
Okay, see the derivation of the Black-Scholes-Merton differential equation. See, the first step is the stock price we assume follows a geometric Brownian motion. So this is what you assume. Okay, now the second step is, okay, we are saying that our the option price follows on two things, which is the stock price and the time component. And this is the formula of ethos lemma. Okay, this is the formula of ethos lemma. So now we are discretizing it. Okay, so if you see df is this, and we discretize it to get this value. Now we assume that the portfolio is what we are shorting the derivative and we are going long on the stocks. Okay, so then what we'll do is my bad. Okay, so see, so you will again, so this is what you have assumed, that okay, you are shorting here, sorry, you are shorting the stock, sorry, you are shorting the option, and you are going long on the stock. And how much you have to how much stock will you buy? You'll say that as delta, and what is delta? Df by dou f by dou s. Okay, then you basically discretize it, and then eventually see, if you see, you have delta s equation and delta f equation, so you'll put it and solve it, so you'll get this. Okay, then the next step is you assume that the stock that your portfolio goes at r interest rate. Okay, see, if you see, the portfolio must be riskless during the time it should grow at some interest rate, risk-free interest rate, which you assume as r. And then eventually you have this component, you have this component, so we'll substitute this, and this essentially will give you what? This will give you the Black-Scholes. Okay, my bad. So this 15.16 is what? The Black-Scholes PD equation. Okay, now you apply the terminal boundary conditions, which is this value, to arrive at the final formula. So this again, see, this is an interview, but I just thought of telling you, okay, how it's been derived and how would you say if someone, and this is the most asked question, how to derive the PD is the most asked question. Is that clear? Please tell me.
So right now you gave the explanation is how to derive PD, right? PDE. Okay.
Okay, so now the next question is, can anyone tell me what are Greeks? Anyone? Yeah, Ruby.
Greeks are the sensitivities of the option prices. For example, delta is the rate at which the option price changes with respect to the stock price. And then gamma is the acceleration, the rate of change of delta. Theta is the time decay. Vega is the rate of change of the option price with respect to the volatility. Rho is the rate of change of the option price with respect to the change with 1 unit of change in the interest rate. And
Okay.
minus
Anyone wants to
Theta.
correct? Yeah, anyone wants to correct the definition of Vega and Rho? Okay, yeah, Shivani, please go ahead.
Uh, I don't know if it's correct, but I'll just try for that. For Vega, it is sensitivity of volatility. So it measures the rate of change of option price with respect to change in volatility of underlying asset. And You said rho or theta, the next one.
Row,
Which,
row.
okay. So it measures the rate of change of option price with respect to change in risk-free rate. Yeah, risk-free interest rate.
Okay, so the answer I was expecting is for Vega, it is of course the rate of change of option price with respect to 1% change in implied volatility. Okay, it is not volatility. When you say volatility, volatility can be historical or implied. This is when we say Vega, we say rate of change of option with respect to 1% change in implied volatility. And what is rho? Rate of change of option price with respect to change in 1% of risk-free rate. 1% of not 1 unit. 1 unit can be anything. 1%, you need to mention 1% of the risk-free rate. Is that clear? Okay. Now, tell me, Agam, tell me, or anyone tell me what is the delta of call option and delta of put option? Yes, I.
Uh, Delta of a call is 0 to 1, and delta of a put is 0 to -1.
Perfect. Can you also break this based on the moneyness of the option? So if it's in the money, out of the money.
So if it's deep in the money, it gets close to 1. If it's out deep out of the money, it's get close to 0. And reflective of put option as well. If it's deep out of the money, it gets to -1. And if it's in the money, it gets to 0.
Okay,
Close to.
perfect. And for at the money in both, so in for at the
At
money
the money, it stays at 0.5.
for
Yeah.
call option, and for put it is negative 0.5.
Negative 0.5.
Okay, perfect. Can anyone tell me how to, okay, and this again, I'm going back to the options. Can anyone tell me how to draw the payoff of a call, long put, short put? Yeah, please, okay, please so I'll ask Shivani. Shivani, please feel free to share the screen, and please, if you could draw the payoff structure.
Sorry, I was on mute. So is there any particular sharing on
Yeah,
Zoom or?
just click on share, and then you will basically see advanced option. In the advanced, you can basically or let's say on the screen on the documents, I guess there will be a whiteboard.
Got it.
Yeah. Yeah, please draw. Let's focus on long call and short call. Let's focus on long call and short call.
Okay. Sorry, my bad. But
Yeah, take your time.
so this is stock price,
Yeah.
which goes up from, let's say, 0 to 100, for example, and this part is the premium one,
Okay.
which we pay.
Yep.
Uh, yeah, and uh, yeah.
And what is the y-axis? So you mentioned x-axis is the stock price.
Yes, this is profit. This is profit.
No. Oh yeah, this is profit. That's right. Yep.
This is stock. This is stock price. This is profit.
Okay. And this is for long call or short call?
This is for long call. So
Okay.
we have.
Mhm.
I was just explaining that our loss is just limited to our premium that we pay, and our profit is going to be unlimited in this case.
Okay. And one more thing, Shivani, is this point is your K, right? Your strike price.
Yeah, strike price. Yeah.
Okay. Now this is for long call. Can you also draw for short call?
Yeah.
Yeah, you can draw maybe in the same thing.
Same thing. Okay. So it's just gonna be like this. So this particular point is gonna be strike price,
Yeah.
and again, this is the stop price, and this is the
So only thing is it will be like this and it will go down, right?
yeah.
Okay.
Yeah, sorry.
Okay.
And
And yeah. So this is your payoff. Your sorry, this is your profit, and your y your x-axis is nothing but your stock price, and this point is your K. Now,
Yeah.
can you draw for long put and short put?
Yes. So again, this is ST.
Okay, make sure you draw, when you draw, you say this, okay, because it goes like this and this. So this is wrong. You say it's a straight line like this, okay?
Yeah, I'm sorry. Because of that mouse, I'm not able to
Oh,
draw a
okay.
straight
Yeah,
line.
yeah. No, but I understood. You know the concept. See, for me, it's important to make sure you understand you know the concept, and I can say you know the concept. Okay. So this is for long put, and can you tell me what is for short put? Perfect. Perfect. Yeah. So
So
make sure you start with here. Okay. Make sure you start with here, and then
yeah.
you draw. Okay. Yeah. Perfect. Perfect. Yeah. Again, this your y-axis is your profit, and your x-axis is your stock. But this is great. Okay, this is great. Perfect. You can stop sharing your screen. Okay, perfect. This is great, Shivani. I'm very highly impressed. Yeah. So now, quick question. Um, how do we, okay, so for a Black-Scholes model, do we take historical volatility or do we take implied volatility? And even before that, can anyone tell me what is the difference between historical and implied volatility? Ruby, please say.
Historical volatility is based on the historical prices, and implied volatility is, what is expected. I don't know the
It's
theoretical
basically how the
definition, but
volatility will be in the future.
projected, yeah,
Projected.
projected.
That's right.
Uh,
Uh,
and in the BSM, we use the implied volatility,
Perfect.
not the historical.
Perfect. And can you tell me the reasoning why we consider the implied volatility?
Because we are trying to project the price, future
Perfect.
price.
Yeah,
So, yeah.
yeah, that's right. Okay, so now the next question is, um, okay, let me see what are the next. Okay, so we assume that in the Black-Scholes model, we assume that the stock price follows a geometric Brownian motion. And if you look at the geometric Brown, okay, first tell me what is the geometric Brownian motion equation? Anyone in the group, can anyone tell me? GBM equation?
There's a deterministic component and there's a stochastic component,
That's right. But
right?
what is the equation?
Um, yeah, the stochastic component, I
Yes,
remember
yes, please say.
volatility times dWt, where Wt is the Brownian motion, and the deterministic part I forgot. I
But
think it is mu t. Is it like mu? The mu scaled by time. Is it?
okay. So yes, please go ahead.
Yeah, so geometric Brownian motion, it tells you the change in the stock price, which is equal to mu ST plus ST dt plus sigma ST dWt. So dWt here is the Wiener process. So volatility is being scaled with Wiener processes or Brownian motion. Yeah.
Perfect.
So
So the
this is
answer
the
is,
GBM
the
equation.
equation is DST, change in stock price, right? DST is equal to mu ST dt plus sigma ST dWt, wherein the mu ST dt is the diffusion part and sigma ST DFT is the stochastic part, or sorry. So mu ST dt is the drift part, and the sigma ST dWt is the diffusion part, which means the stochastic component. Now, what is dWt? So when I say sigma ST dWt, what is the dWt? Yeah, yeah, Sai.
Linear process.
Wiener. Okay, now can anyone define what is the Wiener process and what are the properties of Wiener process?
Can I say?
No, please wait, Ruby. Anyone else?
Okay, okay,
Can
okay.
Yeah,
I?
yeah.
Can I? So basically, so the Wiener process is defined as a Brownian motion, which is the stochastic process, which means random. It has a continuous movement within the price, uh, with the price of the underlying asset, and also, yeah, and also it generates the random paths.
Mm-hmm.
for the underlying assets.
And what are the properties? So Wiener process, as you mentioned, that's right. That it is nothing but a random walk. Okay. Now, these concepts again come from physics, in which in physics we say random walk of a particle, but when it comes to finance, we say random walk of the stock price. Now, can anyone tell me, Sai, can you tell me what are the properties of?
Uh, the process is independent and incrementally normally distributed.
Okay.
Uh,
Okay.
to the
Give me
properties.
five properties. Or anyone who can give me five properties. Yeah, Ruby.
Yeah.
Okay.
I can give one. I remember one. The
No, please,
variance
please
is
five. No, please five.
five. Oh, sorry, five. I
So
don't
Four or
remember.
five. Yeah.
so first is the continuous path. It has a continuous path. Second is it has a
Mm-hmm.
stationary increments. Third is it has a normal distribution. Might be, yeah, it has a normal distribution increments which follows the bell shape curve, right? Yeah. And third and fourth is it has an independent increment.
Mm-hmm.
Yeah, it has an independent. Yeah, that's
So two more properties. Anyone else? Yash?
So, yeah, Wiener process also has Markov property as well as Martingale.
Perfect. These
Yes.
were the two things which I was actually looking for. It follows a Markov process and it also follows a martingale. Now, can someone tell me what is a martingale? Yash?
Yeah, so expected value of the process is equal to exactly equal to the current state of the process, irrespective of how the process has evolved.
Mm-hmm.
So that is martingale property.
Okay. So
Yeah.
basically that's right. And can you define with the help of a formula also? Do you remember a formula or something?
I don't remember the formula
That's
exactly,
fine. That's
but
fine.
yeah.
But please look at it. But yes, Yash is right. The expected value of the future random process should be equal to the present value. And if in case it is not equal, what will happen? Arbitrage opportunity will exist. And that is why when we say that in derivative pricing models, martingale is very important. Okay, martingale is very important. Otherwise, arbitrage opportunities will exist. And when we look at all this model, we say that the one of the assumption is market is efficient, which means is not there. Opportunities of arbitrage are not there. Is that clear?
so. Just have a quick question on that. When we usually identify that the arbitrage opportunities is not exist, how can we identify? What are
See,
the parameters? What are the benchmark that we know that this model is like particular the arbitrage model? I mean, arbitrage is not.
See, these are the assumptions of the model, right? That we
Okay.
assume that the model it will work great see, it's something like this. We'll assume that the model works great when there are no arbitrage opportunity. But definitely there are sometimes there are arbitrage, but then again, those arbitrage are for very short time because people in the market will use those arbitrage for their benefit. So even if someone sees arbitrage, it closes very soon, right?
Hmm.
So that's why it's very important that you say that okay, arbitrage, there are no arbitrage, and Martingale make sure that there are no arbitrage opportunities. Okay, all right.
Okay.
Can anyone tell me what is the Markov's process?
I can try.
Yeah, please, Shivani.
So it means that the future behavior of process is based on the current state.
Okay.
Yeah.
Anyone else? Yeah, that's a good definition. I'm not saying that's a wrong.
Just to add, it's independent of the past.
Yeah. This is what I wanted to hear. So what happens is, I said, tell me, all of you, tell me one thing. If I have today's stock price, will it incorporate all the events that has happened in the past? Yes or no?
No.
Why
No.
no? Why no? It will now. I
Yes,
mean,
yes.
Yes,
yes,
yes.
nah. See, if we have today's stock price, let's say a company started 10 years back, how the company has performed in last 10 years, we can basically understand from today's stock price, right? Like how basically every
Yeah.
day the stock is capturing all the events, right? So over the years, the stock has captured all the events and that's why it's going up and down, right? So when I say that, okay, I have today's stock price, it means that it has captured all the things that has happened over the last few years or whenever the company started, right? And that's why we say that, okay, now we do not need any information from the past because as of now, we have all the information.
Hmm.
You will understand, Shivani? Do you understand this? Because see, when we say that okay, we the for the this stock follows a Markov process, that basically means okay, today whatever we information has, okay, it has already captured what all events has happened in the past, and that's why if we have just today's price, it's more than enough for us. Good, good. Okay, that's great. I guess great going so far. I have few more questions. Um, okay. Okay, so tell me, let's say as I was mentioning that we need to derive the PDE or the closed form solution, closed formula for any let's say the Black-Scholes model. But let's say if we do not have the closed form solution for a specific option, what will you do? What other processes will you follow? Or what other steps would you do? Sai.
A binomial option pricing.
Um, okay, that is one option. That's right. But let's say, okay, but let's say we do not have any closed form formula. We do not have any closed form formula. Then what will
Yes.
you do?
So in that case, we'll use a numerical solution. We'll use Monte Carlo simulation in this case
Perfect. This is
to,
what
yeah.
this is what I wanted to hear, that we'll shift to when we do not have any closed form solution, we'll shift to the numerical methods. Methods like Monte Carlo simulation, or I'm not sure if you have heard about the finite difference method or the least square Monte Carlo method. These are numerical methods which are useful for modeling the option prices. Okay. Okay. Now
Yeah, just have a quick question on that. What is a closed form solution? I mean, what it means?
you tell me what it means.
Uh, I mean, I'm genuine. I'm not aware on that.
So if you see Black-Scholes formula, right? Okay, yeah, yes.
Uh,
So yeah, so sorry, I mistakenly did that, but I'll answer this question. So like Black-Scholes model is an example of closed form solution.
okay.
So wherein you finally get a value out of it. And so the final value which you have, that is given by a closed form solution. But Monte Carlo simulation is a numerical solution. So it doesn't give you a value, but it runs a large number of simulations so as you arrive to a particular value. So
Okay, got
yeah.
it. Perfect. Yeah.
Right.
Thank you.
That's right. That if you see the Black-Scholes model equation, you have this, C is equal to S naught ND1 minus K times ER, E negative RT ND2, right? So this is a proper formula, closed form formula, right? You have arrived. But if in some case you're not able to derive the formula, then you can shift to Monte Carlo methods. Okay, can anyone tell me what is put call parity and what is the final equation? Uh,
No.
wait, Ruby.
Yeah, it's like if we long a call option and short a put option, we end up with the futures. So if we put it in a formula, it is C minus P equal to S minus K times e to the power minus RT.
Say that equation, C minus P is equal to.
C minus P equal to ST minus or S0 minus K to the power K times E to the power minus RT, like the discounted strike price. S minus K E to the
Yeah,
power
that's right.
minus
That's
RT.
right. That's right. That's right. Okay. So can you, okay, but the question is, please, okay, one more thing is, and this is for everyone, that whenever you are saying the answer, please tell me the complete answer, not the component of the answer. Please tell me who can tell me the complete answer. What is put call parity and what is the final relationship Ruby said, but anyone who can tell me complete. Yeah, Ruby.
I'll add to that. So put call parity, what it means if is say if we have the value of a call option, what is the fair value of a put option for the same underlying, for the same strike price, for the same maturity, like the fair implied fair value of a put option given the price of a call option. I
Okay,
think,
that's
if
right.
I'm not
So
wrong.
that is right. Anyone else who wants to try? This is the right, but anyway, yeah, Shivani.
Yeah, so put call parity is the relationship between European call and European put option with the same strike price, let's say K, and the same expiration date. And in put call parity, we assume that there is no arbitrage opportunity.
Okay, yeah, that's right. That's completely right. So, Ruby, the thing that you were missing was European. Okay.
European,
And
yes,
yeah,
yes. Uh-huh.
yeah, that was. And what is the portfolio being considered? Can anyone tell me? Because in the put call parity equation, we consider two different portfolios. So, what are those portfolios?
Can I say
Yeah, please go ahead.
more? One portfolio is a one long call option and then one bond, like cash K discounted, and the other portfolio is a long stock
Mhm.
um, and a long put.
Perfect. Perfect. And make sure if you do not know this, please make sure to understand how the derivation happens, because this is also important. Like what are the portfolios, how to derive it, and how to arrive at the final formula. Now, can anyone tell me what is now I'm moving a little towards the trading strategies part of it. Can anyone tell me what is a straddle? Please wait, Ruby. Please wait. Anyone
Yeah,
else?
sure, sure.
What is a straddle? Yes, yes.
So are we talking about a short or long straddle? Like any straddle would work?
Long straddle.
Okay, so in long straddle, what we do is at the money, we try to buy a call, and as well as at the same strike price, we try to buy the put.
Okay.
So that's a non-directional strategy, which requires the volatility to be less. And
Less
so
or
we
high?
try to,
Less
huh?
or high? Do you want the volatility to be the less or
To
high?
be very less. We want the volatility to be less, and we want the market to be sideways in this case.
Okay. Okay.
Yeah.
So I
And
would say, yeah, that is wrong. I mean, the portfolio
mm,
construction which you mentioned, long, so at the money, long call, and at the money, long put, that is right.
yeah.
But, and Ruby, do you want to add something?
Yeah, I think straddle, isn't it like one call option at a higher strike price K2?
No.
Because what Yash mentioned, I think that's strangle. Straddle is two different strike prices, if
No,
I
he
remember
mentioned
correctly.
correctly. He mentioned correctly, Ruby. So, okay, here is one thing.
Okay.
So, what is straddle? It is basically long call and long put. Okay, so, okay, tell me one thing. If you are in a long call, what is the maximum loss you will face? Please tell me. In the long calls, just imagine you have a long call option. What is the maximum loss you can face?
Premium.
Premium.
The
Similarly,
premium.
for long put, what is the maximum loss you can face? Premium, right?
Premium.
Premium.
So
Yeah.
when you so maximum loss in this whole strategy of straddle, the maximum loss is what the both the premiums, premium of call and premium of put, right? So what you want is in this specific strategy, you want the volatility to be high. So when you know
Yeah, right,
for
right.
a specific, let's say Nvidia, it's the volatility is pretty high, so you go in that, not Nvidia specifically, but let's say any specific stock in which you feel the volatility is super high, you go into long call, long put in the straddle opportunity, and the payoff will look like a V structure. Okay, payoff is what V structure, and you are assuming that the volatility will be high, so that in either direction, if it goes, you are making profit. So when yes, you said okay, the volatility should be less. Always remember, when you're in a long position, you want the volatility to be high, but if you are in a short position, you want the volatility to be low. All right. So
So
now,
just have a question, Mehul, on that. So we are buying the options, the put and call with a one company, right? That's what the
yeah,
strategy means,
yeah,
right?
yeah, yeah.
Okay, got it.
And anyone who knows straddle and strangle. No, straddle and what was the other one? It was strangle. Am I saying that right? Yes. Yeah. Ruby, please say what's strangle.
Strangle, yeah, I was confused. I always get confused between the two. Strangle is the one where you buy a long call at a higher strike price and you have a long put at the lower strike price.
Okay.
So like it's not at the same, but the
So
same underlying.
yeah,
It's
that's right. So the way to say is you basically go long on call, long on put, but the only thing is you go deep out of the money. Okay. The way to say
okay.
is deep out of the money. Okay.
Deep out of the money,
Because this
right?
makes things easier. You instead of saying
Yeah, yeah.
the formula, you just say
Yeah,
deep.
yeah, yeah. Out of deep
Yeah.
out of the money.
And does anyone know how does the payoff look like for this strategy? Yeah. So Shivani, you said
Yeah.
no. Can you like this? So it's base. Okay. So it's something like this. Just look at this. Then it's a so for a
Mhm.
straddle it's a V. For strangle you go like this. Then this, and then this. Okay.
Like a bucket.
Bucket. Yeah. Basically,
Mhm.
that's more like a bucket. Okay. That's right. So, okay, that's perfect. So, okay, tell me one thing. Why do we consider risk neutral? We say that, okay, let's assume that this pricing model is risk neutral model. Why do we say risk neutral? What happens? Yes, I.
Because we consider that stocks are log normally distributed.
Uh,
Uh,
but then, where does the risk neutral comes into the picture? Why we assume risk neutral?
uh, there are no arbitrage opportunities in risk.
No, that does not relate with the risk neutral. Ruby, and you have any idea?
Yeah, to make it uniform because different investors have different risk appetites and growth rates, right? So
See,
to make the pricing,
yeah,
yeah, uniform to take out that difference, or what do
that's
you
right.
call the term? That difference to make it uniform.
Yeah, so what happens in the real world, every investor has different risk appetite, and of course, they will be, they'll expect different returns. So when we say risk neutral, we means that irrespective of whatever, irrespective, the investor will get our interest rate out of the investment, right? So why we assume risk neutralism, it makes our calculation easier. That's why we make go into risk neutral world. Okay, can anyone tell me when we come from a risk neutral world to a real world, uh, so what will happen? How do we, okay, two questions is, how do we translate the probabilities, and how do we adjust the equations? These are two different questions. First is, how do we adjust the probabilities from a real world to a risk neutral world? So there's this thing called radon nicotine. Please, everyone, write radon nicotine. Radon nicotine. What it does is it will adjust the probabilities from a risk neutral world to a real world, right? And the second thing, what I said is so once we know how to adjust the probabilities, the second thing is how to adjust our equations. If you see in the GBM equation, we have to adjust those equations also. How do we do that? There's this theorem called Girjonov's theorem. Girjonov's, Girsanovs, Girjonov's theorem. What it does is it will basically adjust the geometric Brownian motion, right? Because of course, we are assuming in the first case, in the risk neutral world, we are assuming that the stock price will go with our interest rate, risk-free interest rate. But in the real world, we adjust the interest rate, right? So what we say is, using Gaussian theorem, we are basically adjusting our GBM equation. Is it clear?
Mehul, can you write that because I haven't done that advanced derivative? Can you write that in the chat?
Yeah,
The that I'm unfamiliar. Thank you.
Gaussian theorem. Thanks so
Thank
much.
you.
Yeah.
Thank you so much.
Thank you so much, Umar. Okay. Okay, so next few questions is, um okay, so let's come back to Greeks. Okay, tell me one thing. So when is gamma the highest for a call option?
I think so.
At
At
the
the
money,
money. At the money.
Yeah, Sai, can you tell me what's the reason? Okay, can anyone draw how the graph of gamma looks like? Can anyone just show me by hands? Just show me.
It looks like a bell structure.
bell curve. Yeah.
Bell-shaped curve. That's right. It looks like a bell-shaped curve. That's right. Now can you tell me? You said gamma is highest at the money. Why is it highest at the money? Yeah, please,
Can
anyone?
I say
Shivani.
because yeah,
Shivani.
sorry.
Because the volatility is highest at the money, so a rate of change in delta would be higher at the money. So
Okay. Let me show you. That is right, but let me show you mathematically how it's done. Okay. So that if anyone asks you, can everyone see my this thing? Can everyone
Yes.
see my whiteboard?
Yes.
Yeah,
Okay,
we can
so
see it.
for a call option, how the graph will look like this. My bad, Ruko. Just wait. Okay, let me draw this graph again. So how will so it will look like a S-shaped curve. This is delta. Do you all agree or not?
Yeah.
This is delta, but then when you so this is okay. Let me write. This is out of the money. This is at the money. Okay, and this part is in the money. Okay, now tell me one thing. This is constant. When we take a derivative of a constant, what is the value?
0.
Yeah, here so this, if you see, this is again constant. What is the derivative of a
Hmm.
constant? Small or 0.
0.
Now this is
0.
evolving. This is evolving. So this will be, that's why we say that when we take derivative of this part, derivative of at the money, that is highest. Now, so that's why when
Hmm.
you see the equation of gamma, sorry, when you see the graph of a gamma, it is like this. See why it is like this? Because this part is what in the, this part is what outer money, this part is in the money. But this part, what it says, so this part, what it says, this, if you differentiate this part, this will be exactly this. Do you all understand?
Hmm.
Okay.
Yes.
So this is how, even if you use any mathematical function, you'll understand this. Okay. If you use any mathematical graph, you'll understand, when you differentiate this, it will come as this. That's why we say at the money is highest for sorry, for gamma is highest at the money, because the oscillation is the highest. Did you all understand? Okay, perfect. Now can you tell me how will theta behave for a call, for a long position versus for a short position? Yes, I.
So the time decay for a call position, the theta after the add the money, it starts to decay, and for a put, it starts to the value of the option starts to decay after if it crosses at the money.
No, no, that's wrong. My question is more like, how does theta behave for for a long position versus for a short position? I'm not diving deep into call or put. My question is, yeah, Yash.
So theta in general, as its nature, it behaves against the buyer of any option and it favors the seller of the option. So
And
for a buyer, the theta would be negative, and so for a seller, the theta would be positive as it favors it.
can you
Yeah.
explain me why is it? Why does that happen?
Because as the option goes through, like the time, so as the expiry comes, the time value of money it goes down. So
Okay.
extrinsic value of the option, it also goes down as the time goes by. So when this happens, right? So the for buyer, it is a bad thing because the buyer wants the premium to increase. But by extrinsic value, as it's decreasing, the premium would decrease for an option buyer, right? And
Premium is price, right?
yeah, the
You're mentioning the stock, not the premium. Stock will increase or decrease, right? Or the premium.
no, the
Oh,
premium.
basically, eventually the premium will.
Yeah. Yes, yes, yes. So the premium
That's
would decrease.
so
Yeah.
how I would explain the same concept. That's right, totally right. Not denying it. So how I would say is definitely for a long position, the theta acts negative. So theta is generally negative, and for a short position, theta is positive. Just to analyze this, let's say you have 3 months and you have 1 week, right? In 3 months, you have more time to get profited versus in just 1 week, you have very less time for the, for the stocks to go in the right direction, or in whatever direction you are assuming. So that's why, for a long position, when you have more time, it's good for you. But when the time is very short, then that's where the problem arises, because now the volatility of stock has diminished. And as I said, options has two things: the extrinsic value, which is st minus k, and the time value of money. These two components is equal to the option price. Okay, so the extrinsic value, which is st minus k, and the time value. But once we go near the maturity, the time value actually diminishes. So that's why the overall option price, it's bad for the holder and it's good for the short position. Okay, can anyone tell me how does the graph of theta looks like? Yeah, Ruby.
Like, can I like that? Like for a long position, like coming down like that.
That's right. No, Yash mentioned bell curve. Sai, please say.
Exponentially decreasing for a long call.
Decreasing, yeah.
Yeah, so
Like
basically
that.
it's like this. You are right. Ruby is right and Sai is right. It goes like this. It diminishes. Okay. So
Mm.
so let me show on the graph. Okay, let me show quickly how it looks like. So let's say, can you all see my screen? So if let's say this is how basically this, if let's say this is the graph, then for how the time value of money will look like is this. Okay, is this clear? And this is what time to expiry. So at expiration, it actually diminishes. Is this clear? Good? Good to go? Okay. Now tell me for interest rates. Let's say, can you tell me how will that behave for a long call, short call, long put, short put? Or just tell me how interest rate actually affects the option price. Can anyone tell me? Is it good for the long call, short call? Acha, tell me one thing. If rates are going high, it's good for long call, short call, long put, short put. It's good for which of these? Yeah, yeah.
Uh, short call, because the opportunity cost would be less, as you are not buying a call, you're not taking the cash, but you could invest this cash into any in any bonds that give you high yield.
No, that's wrong. That's wrong. Anyone else who wants to try? Uh, yes, did you
Yeah.
raise hand? Yeah.
Yes. So for interest rates increasing is typically bad for the call buyer, because once the interest rates increases, the stock prices normally decreases in value as we. One second. I'll reframe. Just give me a second, I
Just
think.
take a minute. Ruby.
Yeah, my take is, say for a long call, if the interest rate increases, then the discounting factor of K that decreases, right? E to the power minus RT. So the call value S minus K that increases. So the long value of the long should increase if the interest rate increases, and reverse for a short call. And then again, K minus for a put, K uh, e to the power RT. For a put, it's the reverse. If interest rate increases, then K e to the power minus RT that decreases. So for a put, if interest rate increases, value of the put should decrease.
So the answer is for long.
Long put.
No, so answer is for long call and short put. Whenever you are buying, okay, tell me one thing. When say it's something like this, okay? If you know, let's say interest rates is X or let's say R, okay? Now I what I generally do is we discount, we discount that specific strike price K times E raised to the power minus RT, right? So we discount. Now tell me if I give you an option to buy something at 100 or to buy something at 95, which will be you more interested in?
95.
95, right? That's right. So if I have the opportunity to buy something at 100 and something at 95, I'll buy at 95. Second scenario. Now let's say if I increase the interest rate, the discounting factor negative RT, is it good? I mean, if I increase the interest rate, is it good for you or bad for you? When you are
Depends on
buying.
which position I am in.
When you are buying something, so it's something like this. Okay, let me explain. So if I'm buying something in the future, right? If I'm buying something in the future, if interest rate increases, and so what will happen, the value of the asset will decrease. The value, because of the time value of money, right? Because of what? Time value of money, the asset price decreases. So I want the asset price to be at 95. So whenever I'm buying something, when will you buy something, so it's either on long call or on short put. Short put also, you are buying the asset. So when I'm buying the asset, this particular thing is good for me, which is rising interest rate. So always say that rho is good for long call and short put, and it is bad for short call and long put. Clear? And if in case it's not clear, I would highly recommend everyone to understand these two things. First is the time value of money. When time value of money is what? E raised to the power negative RT. E raised to the power negative. So when this component, when this component goes, it will have an effect on your total value, right? So that is the thing you have to explain to the interviewer. Is it clear? Okay, now coming back to volatility. Is volatility good or bad for your option buyer?
Good.
Okay, and for option seller, is it good or bad?
Bad.
Bad.
And why is it?
Because if volatility increases, then premium of the option increases. the value of the option increases, chances that it will be in the money increases. So that's bad for the option seller.
Yeah, Yash, anything else you want to add?
Yeah, like I had the same point that the probability of the option expiring in the money increases due to heightened volatility. And so this favors the option buyer. And similarly, if the volatility is less, the lower is the probability for option expiring in the money. And option seller wants the option to expire out of the money.
Okay.
So yeah, it favors the option seller. Yeah, lower volatility.
Perfect. Last 2-3 questions. What is a binomial tree?
What is a, sorry, what?
Binomial tree.
Binomial?
Tree. Binomial tree.
Oh, binomial tree. Can I say?
Please raise hands whosoever wants to answer. What is a binomial tree?
Oh,
Ruby.
actually, I'll pass. Sorry.
Yeah, Ruby, please say.
It is like I might not know the perfect definition, but from what I remember, it is the discrete, like BSM is for the continuous pricing model. Binomial tree is the discrete pricing model.
Model which is used to price American options. Okay.
American options.
Okay. Now, can anyone tell how does the process of binomial tree looks like? Yeah, Ruby.
So we have a starting price of our underlying asset, and then we calculate the U and D, up jump and down jump. There's a formula for that, I forgot. And then we also have we calculate the P, the probability of going up and the probability of the stock going down. So we calculate at each node the up jump, what the stock will be from. We have S0 and SU and SD. And then from each node, we do that S up and S down. So when we finally reach the terminal values, we have our terminal values of the S up and S down. Then we start calculating the option prices from each terminal. So when we reach our final terminal node, so say we have 3 nodes. At the third node, we have our SU, SD at each node, at each point. So then we calculate the option price at each node. Say if it's a call option, then it's ST, whatever, say SU minus the strike price. And for the down node, it's, S down minus the strike price. We do all of that. Then for the node prior to that, we discount, like apply the probability. It's P times SU plus Q times, Q is 1 minus P, Q times S down.
Perfect. That's right.
And then discount that e to the power minus RT
Perfect.
by whatever that time period
Yeah,
is.
this is perfect.
And then we come all the way to the first node, discounting that way.
Perfect. This is the perfect answer. Okay, so how I would have gone is, of course, binomial tree is a discrete time model which is used to price American option or any callable bonds. Now, there are certain assumptions that the binomial tree takes in. First is definitely it considers that the stock price can go either up or either down. Second thing is it assumes constant volatility. And third thing is it assumes constant interest rate. And the last thing is the markets are efficient, which means there's no arbitrage opportunity. Now, how the tree works is basically we make this assumption that the stock goes up and down, and using this assumption we'll basically construct the tree. Now at the terminal node, which is at the terminal node, what we assume is we basically not assume, but at the terminal node we'll basically apply the formula of call or put. Assuming it's a call option, we'll apply maximum of st minus k comma 0. If it's a put option, we'll apply maximum of k minus st comma 0. And then once we have the values at the final terminal node of the options, we'll follow a backward induction process. So in the backward induction process, we basically multiply the up node with the up probability, and the down node with the down probability, which is nothing but P and Q. We'll follow this process, discount it, and discount it to arrive at the final option price. Perfect. Sounds good. Okay. Now, can you tell me, does binomial tree converges to Black-Scholes model?
Yes,
How?
because it simulates if the binomial paths it
How will it when will it converge? What will you do?
what I um Actually, what I understand is, if the paths are into the multiple times, it automatically converts to the Black-Scholes.
Perfect. So that's right. So, in a binomial tree, we assume delta t, right? The paths delta t, delta 1t, delta 2t, and so on, right? It starts on 0, then delta 1t, delta 2. And then if we take like multiple time steps, it will actually, Black-Scholes will actually converge to binomial tree. That's right. Now, how will you calculate Greeks for a binomial tree model? Like if I want to calculate delta, how would you calculate? Yeah, Ruby.
So for delta at each node, like we will have to calculate the delta at each node of the binomial tree, right?
No.
So no.
So the answer is basically will basically use the finite difference method. Now, what is the finite difference
Mm.
method? Basically, you will basically either upshock or downshock the stock price. Okay, and then you basically take the difference. I mean, if you just look at the finite difference formula, we all have studied. Okay, for delta, gamma, rho, theta, vega. For delta, will do the same. Gamma also will shock the stock price. For vega, will shock the volatility. For rho, will shock the interest rate, and for theta, will shock the time factor. Okay, is it clear? So when I say time factor, instead of saying okay, the it's maturing in 1 day, we'll assume 2 day, or 5 days to 6 days. So we basically add a time component of it. So like this, we'll basically see how our option prices affect when we upshock or downshock, or let's say you can just take base and upshock. So you can look at the finite difference formula to arrive at the Greeks for this. See, the only difference between Black-Scholes formula and binomial for Greek calculation is in Black-Scholes, you partial differentiate the equation, right? With respect to this different components, the stock price, the volatility, the time factor, the interest rate. But in binomial tree, we are not partially differentiated. Instead, we use this process called finite difference method. Is it clear? All right, guys. This was,
Can you
yeah.
can you explain the finite difference one more time, please?
Yeah,
Little bit.
yeah. So basically, Agam, what we do is, let's say we want to calculate delta. Okay, so if you look at the finite difference formula, what it says is the up value of option price minus the whatever the base is, or let's say if you want to go the down price, so up price minus the down price divided by 2 times delta. What is delta? How much you have fluctuated. Let's say if you have fluctuated $1, so 2 times $1 that will be in your denominator. So on the numerator part, it is nothing but the up price, whatever option price when you shock up, and then you subtract it when the option price you shock down, and divided by 2 times delta. Delta is what? How much you have shocked, which is $1. And similarly, you follow the same technique for all the rest of the Greeks. In theta, you'll shock what time. In vega, you shock what volatility. Okay. All right. So guys, this was all. You all were fantastic audience, and specifically all of you have given great answers. I'm stopping the recording, but eventually this is for all the people whosoever is watching this. See, in any Quant interview, if in case you're not able to give three interview questions, you are out. And that is how so it's so competitive, at least in the United States. Okay. So please make sure if you are preparing, please make sure you have thorough with all the concepts of derivatives. I know I have asked a lot of detailed questions, and this actually requires a lot of in-depth knowledge of derivatives. But eventually, if you are able to answer such so many questions, the interviewer will be highly impressed. So please make sure you prepare well, and I wish you all the best. And thank you all of you for being such a sport.